Welcome back to A Bite from the Money Sandwich, where we provide practical and easy to understand tips and ideas on how to manage your money better, so as to let you retire with comfort and on your own terms. If you were told there is a 70% chance that your house or car could burn down, you'd insure it, wouldn't you? Well, it's the same when it comes to your own personal situation and getting covered to make sure you and your family are protected when the unexpected happens. Today, I'm speaking to Tim Ross, who is a senior partner and financial advisor of Henderson, Ross & Co. Financial Group. Tim explains why it is important to understand the different types of insurance to make sure you have the best coverage, plus why life insurance also creates security and a safety net for you and your family. Well, welcome, Tim, to the show.
Thanks, Marc. It's great to be here.
Well, this episode's all about really life insurance. And one of the things is when people talk about insurance, they basically all throw it in together. General insurance, home insurance, car insurance, and life insurance. Life insurance is very different though, isn't it?
It is different for a vast number of reasons. I won't go into depth with all of them as to where the differences are. A couple of key ones though, that might help your listeners get a better mental picture of life insurance. It tends to be a product that people hang on to for a long time. And there's a couple of reasons for that. One is that, they're assessed when they put in an application generally for life insurance. And obviously, the younger you are and the healthier you are, the better it is in terms of the underwriting outcome you might get. So, if you're applying later in life, you might get a loading because you've got some specific health problems that make you a higher risk for the insurance company, or you might get some specific things excluded from the cover. So those things can mean that it's more difficult to apply for and get insurance when you're older, as opposed to when you're younger, it's a bit easier. So that tends to mean that people tend to hang on to policies for quite a long time.
Now, I suppose being underwritten at the beginning is going to be a lot easier if there is ever a claim potentially later on, compared to if you just get an insurance policy and then they do the underwriting at claim time.
You definitely don't want that because, again, unlike car insurance, house insurance, while certainly there can be significant and catastrophic loss of those assets, that can happen, and you certainly want your insurance to come into place at that time. With life insurance, or any sort of disability insurance, once a claimable event has happened, that's not the time that you want to find out what the clauses are within the policy that could maybe affect the way that the claim is assessed or the way that it's viewed. And obviously, if you find that you've not got the right policy for you at that time, very difficult then to change to something else because you've now definitely got a situation that would need to be disclosed and that would have a significant impact upon the insurer's assessment of your application.
And if we're even looking at life insurance, well, life insurance it's really under the umbrella of life insurance. There's different types of life insurance, isn't there?
Yeah, there are. So, traditionally going way back, back in the dark ages, maybe like back in the 60s and 70s and 80s to some extent, people often had what they called whole of life insurance, where you paid a premium. And the sum insured was generally quite low, but over time there was an investment component that would give you a bit of a return on profits from the insurance company as well as bonuses. And the premium remained constant for the whole life of the policy, but they were difficult to explain to consumers and they seemed expensive for what you got. And so term insurance became much more popular, which is it's kind of like your car insurance in the sense that you've got an amount of cover. There's an agreed premium that you pay for that 12-month period. And then next year, it automatically renews. Your cover goes up a little bit with CPI, but the premium goes up with CPI and also with your age. And they reassess effectively based on your age each year.
Right.
And so you start to see term insurance premiums get quite expensive. Now, term insurance pays simply if the person dies or they're diagnosed with a terminal illness, then the policy will pay out. But other types of insurance that come under the banner of life insurance include TPD insurance, which pays a lump sum benefit if people are assessed as being totally and permanently disabled. And that can take a number of different elements as well, whether it's assessed against an inability to do any occupation, for example, or whether it's assessed against an inability to do your own occupation. which is usually a little bit better for the person who's insured.
And we'll get back to, but that's one of the reasons why getting advised on insurance is so important, to understand those subtleties. But we'll talk about that later. Yes.
Yeah, sure thing. And then there's also trauma insurance, very important. I think we'll be talking about that a little bit later in our discussion. And then there's income protection. So that also all generally falls under that heading of life insurance.
And if we start at the beginning with the life insurance or the term insurance, I imagine you would, if you've got a mortgage or you've got debts, if you're married and you've got some debts, that's the perfect example. You don't want to leave a loved one or dependents with a huge debt, potentially losing the house. So that's a perfect example, I imagine, why you would have term insurance.
Oh, absolutely. And again, your listeners would be fully aware that, what we've seen happen to property prices in Australia.
Yep.
So for anyone who's getting into the property market, you think about the size of debt that they're having to take on. I remember when my family arrived here from Scotland in the late 1980s, we bought a property in Brisbane, a family home close to a great school, and the house had everything that a family of 5 people needed. And it cost my parents about $80,000 back at that time.
Wow.
And you kind of look at it now and you couldn't get the same property for 10 times that amount of money. So we look at what debt levels are that people are having to take on to house themselves and their families. So the debt levels are high and the reliance upon their personal exertion income is really high, which means that, lump sum cover for catastrophic events is an absolute must for us and our families. And certainly protection of income if we get sick is also really important too.
Okay, so you're talking about temporary. So if you do get sick and you need protection of your income, and it is, people forget that is an important asset because, it's the ability to pay for your lifestyle. So how can that'd be income protection, I presume.
Income protection. And again, there's a wide variety of then benefits that you can apply for. You can apply for up to 70% of your income to be covered. So if you earn $10,000 a month, as an example, you can generally apply for around $7,000 a month of cover. And there's a variety of options in terms of how quickly you would like to get the benefits paid to you. So in other words, how long do you need to be sick for before the monthly benefits would kick in? And then there's another element called the benefit payment period. And that's how long would you like those benefits potentially to continue for? So, people can get a 2-year benefit, 5-year benefit, or generally age 65, which is preferred because if you have a major event that would see you no longer able to work for the rest of your working life, which has happened, we've got clients that's happened to, having an age 65 benefit means that you don't have to worry about that regular income coming in because it will be paid by an insurance company. And then it's indexed as well to take care of inflation because obviously over years, the benefit of that monthly benefit reduces as the spending power of your money decreases. So most insurance policies will allow cover to be indexed each year, CPI protected to make sure that it remains relevant.
And you've said 2 things there that I've probably would like to get a bit more of an explanation of. You said the maximum of 70%, and I presume that a lot of that is because if it was 100%, there really wouldn't be any incentive to come back to work. Whereas at least it's 70%, and it is actually of your gross salary too, not your net salary. If it's 70%, it just gives you that. Yes, it's there to help cover you, but it's not there to sort of say, no, I don't want to actually come back to work.
Yeah, look, that's true. Yes, the way that the products are set up is to try and encourage people where possible back into the workforce.
Yes.
And there's a number of reasons for that. It's not just to get people off claim, which, I guess cynically we could kind of think about it like that, but it's not really like that. There's a big link between people's mental health and people's feeling of self-worth, what they're able to contribute and to be active, which are actually a lot to do with what we do on a day-to-day basis, and while perhaps I'm not having the pressure of working kind of sounds appealing, I think most people would like to have that option. And so I guess having the benefit capped at around 70% certainly provides an incentive for us to be thinking about the possibility of getting back to work if we can. And most insurance companies will also have ways within their products to try and encourage people and support them in their attempts to get back to work as well through maybe some sort of vocational retraining and things like that. If the insured person is open to that, there's usually opportunities there to work with the insurer to help people back if possible. But certainly there are some cases where that's just not possible. Person breaks, their neck or their back has a major spinal injury and can just never really work again. It's unlikely. Well, that monthly benefit then is a godsend because it's really there to provide that ongoing income.
Absolutely. And for someone who did snap his Achilles playing soccer, and I know you're a very good soccer player too. Well, I shouldn't say two, you are a very good soccer player, but 3 months on a couch, I was absolutely stir crazy after a month. So yeah, it sounds appealing, but in reality, being an insurance company that provides a proactive approach to get you back to the workforce is great.
Yeah.
The other part is, and it's important, you are an advisor, but this is not advice. We're just talking about, but in your experience, we would see if people can afford a certain level of premium, would it be that you would say, okay, and because you've mentioned a few times, I'd rather have cover going to my full retirement period than maybe saying having a 14-day waiting period, maybe a 30-day waiting period or 2 months waiting period to reduce it at one end. You're not going to get the benefits as quick, but if it helps keep the premium reasonable, that would be, in your experience, the sort of thing people are looking at.
Yeah, look, there's no doubt that insurance isn't cheap. It is actually quite an expensive exercise to get yourself properly covered, given the levels of debt and so on that we've spoken about that your average Australian household is now having to cope with if they want to, buy a house and educate the kids and all that kind of stuff. But yeah, sometimes we see, it's different drivers. Like if we meet with a client and the client has got limited funds and limited backup in the immediate term, a shorter waiting period is necessary because, they can't afford to have like a 90-day waiting period where they've got no income coming in for 90 days. If they're a self-employed person and they've got very little to fall back on, they kind of need benefits as quickly as they can get them. So they might sacrifice, for example, an age 65 benefit, because if they look at a 14-day waiting period and an age 65 benefit, it might simply be too expensive. So they might look at, well, a 14-day waiting period, but they might take a 5-year benefit payment period, and they might just take a bigger amount of a lump sum cover like TPD, and maybe think, well, if I'm not working in 5 years, in all likelihood, I'm probably not going to work again. And in reality, most people, if you ask them, what's the longest you've been off work sick? It's usually a week or two at the most. Or, you get a physical injury like you with your Achilles. But in this day and age with hybrid workplaces and people can work on Zoom and things like that, even a broken leg, once someone's over their initial period of incapacity, they might still find that they can actually be quite active on their laptop or at home, having meetings on Zoom, all that kind of thing. So there's a wide variety of options available within the products, so you can try and find something that will fit with the client's budget. There is also the opportunity that people can fund some of these things using their super. And so that's another conversation that we have. It's usually less preferable than funding it privately for a couple of reasons. Just the rules around super are quite tight. They can certainly pay a regular benefit, but the main one for me is the fact that super funds only get a 15% tax deduction, whereas most individuals are paying a higher rate than that at a marginal level. So they're usually better to pay those premiums and get the tax deduction personally.
Because that's right. So income, not all insurance policies, but income protection is one of those policies that the premium is tax deductible.
Yeah, and it's tax deductible, but at the other end, when you're getting your monthly benefit, it's taxable income, as opposed to a lot of the other lump sum benefits that you get where the benefits are not taxed.
Right. But you did mention superannuation. So let's go down just to touch on that. Life insurance and total and permanent disablement, TPD insurance, is allowed to be paid for out of your superannuation benefit or as part of your contributions. Do you want to, pros and cons of having life insurance under super?
Okay, so as far as having life insurance under super, in my view, it's just my view, my personal and somewhat professional opinion on life insurance and super. It's a great idea if you've got a family, you've got a partner and dependents. Having your life cover in super makes a lot of sense. the premiums outside of super, if you were to pay for them personally, are not deductible. So that's, so that's a mute point between, having an outside of super. Whereas if the benefits become payable, so if a member dies and their superannuation benefits are paid to their dependents, then those benefits, when they're paid out, they're not taxed either. So the fund can claim a tax deduction for paying your premium, but the benefits themselves, if they're paid to a tax dependent, are not taxed. So that's a reason why I can't think why you wouldn't have it in super. The only time you may not have it in super is if, for example, you want the benefits to go to people who are non-tax dependents. That can be an interesting scenario. So sometimes we'll have clients who actually don't have any tax dependents, and they want to take out some life insurance, maybe to cover a mortgage or something like that, and they want to leave that to another relative. It might be one of their siblings, like another adult person, but maybe a brother or a sister, or it might be to a nephew or a niece or to someone else because they might not have children. Having life insurance and benefits in super, in that scenario, if those benefits become payable to those people that they've nominated, the benefits may be taxed. And so there's things to consider there. It's not always a simple consideration. Everyone's needs are obviously different, and understanding those things is quite important when they make a decision as to how they want to pay for their cover.
And on that, and when you're looking at the amount of life insurance, also I shouldn't say the amount, the premium for life insurance coming out of your super funds, one of the sort of, it makes just sense that if it's costing you $1,000 out of your super fund, you might consider, well, okay, I should make extra contributions to cover that premium. So from an investment point of view, your superannuation isn't getting derailed because it's taking some of your insurance. Paying for insurance,
because we have seen that, and traditionally even the regulators have recognized that that's a problem, potentially, is that people are robbing Peter to pay Paul, and sometimes they've not really been keeping an eye on the fact that their super benefits are being eroded away by ever-increasing insurance premiums. So that's an important part of having an advised relationship, because you're an advisor can run through that with you each year and show you how the impact of that might be impacting on your super. It's not so bad when you're 22, but when you're 52 or 62, the impact of premiums coming out of super can actually be quite a major one. And so it's important to keep an eye on that as the years move along.
And to give you sort of an example, and we're just making up numbers here, if someone was 25 and their insurance premiums might be $200, $500 even, but it's when they're 52 and those premiums are now $5,000.
Well, I'd probably say if they're 25, the premium might be $1,500 if they've got their cover properly organized and if it's covering a decent amount. But if they're 55, that same cover might be costing them $15,000 a year.
And if you're saying someone who was on 75,000 and there's roughly just over 10% superannuation guarantee, so it's about 8,000, you're sort of thinking, well, okay, if out the 8,000 contributions are going in, if your insurance premiums, as you just suggested, was up to $1,500, is still a majority of it is still going into your superannuation. It's exactly as you said. If it's 5,000 or more, then that's a significant hit to you. So people do need just to be aware of that. But for all those benefits you said, it's all tax-free. There's a deduction to the super fund. So there are some very good reasons, but you should, that should be tracked or have an advice.
And I will just add to that,
please.
The life benefits are tax-free. TPD benefits, depending on your age, may not be tax-free when they're withdrawn. So there's lots of calculations, lots of rules around things when benefits are held in super. Just important to make sure that you get the right advice and that you understand what the implications are, even at claim time, in terms of the way benefits are taken, whether it's a lump sum, whether you take a pension. There's lots of ins and outs of how the tax will affect the net benefit that the member gets. So it is important to get advice at that time.
Good point. Then the last one is trauma insurance or critical conditions insurance, which to me is there's very little of it's sold in Australia, and it should be something that everyone should have. They don't need a lot of it, but you would like to make a comment on that?
Yeah, just before we move off TPD, just one other thing I was going to mention.
Sure.
So super funds, while they're allowed to provide TPD benefits, they're restricted in the assessment of TPD. So for someone to get a TPD benefit paid out to them from super, they need to be assessed as being unable and unlikely to ever engage in any occupation for which they're reasonably suited by means of their education, training, or experience. So it's an any occupation definition. That's the only one that you can now purchase through Super. Whereas there's another definition available called an own occupation definition, which says if you haven't performed your occupation, usually for 6 months, and if you're deemed to be unlikely to be able to perform your own occupation again because of what's happened to you, the benefit will be paid out. So quite often, particularly with people who've got quite specific skills in an occupation, and they really want to make sure that if they can't do that job, that they're going to be paid. Sometimes we'll take an element of their cover within any occupation definition in Super, and a lot of life insurance companies now will allow you to take out a second policy, effectively, with an own occupation, where you kind of hedge your bets a little bit, and the insurance company will work with you at claim time to work out which is the best one for you to claim on. So some kind of tricky things that insurers are doing to try and work within the legislation and to also make sure that our customers and clients are being given the best options to consider if there's a bad situation that they're going through.
And you are making very good points. It's really overall, it's showing you the complexity that life insurance, you think, oh, okay. When people say, oh, yeah, I've got some life insurance. And then you say, well, how much and what type and where is it put and all this? Very few people can answer that question because, life's busy and people are busy. So we get that, but just shows you how getting some good advice on this is so important. Okay, so trauma insurance, or also known as critical conditions insurance, that's the sort of insurance so that, a lot of, and I'm one of those people, you have a heart attack, stroke, cancer, it pays you a lump sum, basically help you recover. And that's a good thing. Most people are recovering. So it'd be great for you to just explain that in a bit more detail.
Yeah, trauma insurance is a fascinating element of the insurance portfolios that people can purchase in Australia. And it's interesting that the birth of trauma cover goes back to the 1980s. And it was actually in South Africa where trauma was born. And it was because of the work of Christian and Marius Barnard, who are well known as being the pioneers of the heart transplant. And they were talking to insurers there in South Africa saying, look, we're saving people from certain death. But other than a bit of income protection, and hopefully not life insurance, but they're getting a bit of income protection, but sometimes their lives are being, catastrophically changed from that point on because we're saving them, but they can't go back to being a bricklayer or they can't go back to being a concreter because their heart's not going to be able to, withstand that level of strain. So they were saying, well, there's surely got to be some way that we can insure people so that if they have a heart transplant or a heart attack or some other major medical event, that they get a specific cover for that. So that's where trauma insurance kind of developed from that idea of giving people access to a lump sum should they go through a catastrophic medical event. And so that's really what trauma is there to provide cover for. So it's really an insurance for the living, you could say, where they've suffered a major traumatic critical illness event, but they've still got maybe significant debt levels that they want to cover, or they might just want to have enough cover so that they've got money in their pocket that they can seek alternative treatments, maybe even overseas, perhaps. I've known some clients that have gone to America or parts of Europe to seek treatment, where some pioneer type people were carrying out revolutionary treatments in particular areas where they couldn't access that locally. So they've gone away to do that. They needed capital to be able to do that because your health insurance isn't going to cover you for that kind of thing. So trauma can be a really great benefit that can help you to do what you want to do at that time. Could even help you with, if you don't think that you're going to have a good outcome medically, it can even help with bucket list items and things like that people might want to do.
Yeah, not really thought of it from that point of view. And I also imagine, if you've got $1 million mortgage, yes, you need life insurance for that, but it would nearly be unaffordable to get $1 million worth of trauma. You'd really, as a minimum, you just really want to get that 6 months, 6 months to get you back on your feet type of thing.
Yeah, well, you could probably in that scenario, you could say, well, what's my monthly mortgage repayment?
Mm-hmm.
I wouldn't mind having enough trauma cover that I've got 2 or 3 years of mortgage payments in the bank, and maybe a little bit on top of that to take the family for a holiday, or just to give us a bit more financial breathing space. So generally, you're right. We don't find many people who've got the budget available to them to buy the level of trauma cover to cover all of their debt level. Or if they do in their younger years, that certainly is starting to get revisited by the time they get to 35 or 40. Premiums start climbing because the claims statistics start to move against them at that point. But definitely having enough so that you're a bit more financially cushioned against the impact of those events. It might even be to cover the loss of the income of a working partner who might say, well, if my partner is going through something, I might need to stop working for a period to help look after them. So again, you might take that into account. There's lots of different ways you can calculate it. And really, it's a case of speaking with your advisor to make sure you get the right level of cover that you feel comfortable enough that you've considered what the impact would be and you've made some provision for that.
Excellent. And then probably that leads really nicely into the final part of this, which is why you should get advice. I'm an ex-advisor, you're an advisor. For me, a lot of it, the best sports person in the world has a coach. The best business person in the world has a mentor or a coach. There's, having people around you isn't just to sort of teach you what you don't know, because you can be the best tennis player. A lot of it is keeping you accountable, keeping you on track, and sometimes just, helping you with what you don't know. Life insurance has one extra in that when you come to claim, having someone on your side to actually help you, in most cases, just to help you with the paperwork to deal with a life insurance company. But, sometimes things aren't always black and white. There's a bit gray, and you may have to deal with an insurance company. And people do have some horror stories when dealing with insurance companies, even though that's very, very minimal. But having an advisor on your side who can go and talk to people and get there when you really can't, because obviously something's happened for you to need to claim, is a godsend, I feel.
Definitely. It's like anything else that's somewhat complex. There's a lot of legalese around insurance and the contracts, and I'm not by any means a lawyer, and but you do have experience, and that experience can certainly provide a hand on the shoulder emotionally for our clients at a difficult time when they're going through a tough time. Our clients definitely know that their advisor is in their corner. We're there to serve their needs and to look after them and to advocate on their behalf and to make sure that they're getting a fair hearing from the claims department and that things are being done in the right way. So when you've got an advisor, I think at claim time, it's essential. But even as we talked about before with those annual reviews, making sure that you're not paying too much for the cover, or that you're not depleting your super if you're using super to pay for the insurance, or that the cover continues to meet your needs, because quite often we find, of course, as years go past, people's insurable needs start to reduce as well. If, they might have inherited a bit of money and they've cleared a bit of their debt, or they've just worked hard and they've paid down their home loan.
Children are older.
Correct. Yeah, there's all of that kind of thing. And at that point, the relationship with the advisor usually moves to the next stage, which is pre-retirees and talking about retirement incomes and what are you going to do with the capital that you've accumulated and how do you get the best use out of that. And then also estate planning and protecting your assets and making sure that they go to the people that you want them to go to and done in the right way, and tax effectiveness and all those other elements that do come into the conversation. But that also even affects young clients who've got families that they're protecting, just making sure that their estate planning is in place as well. So there's a lot of that too. I mean, some people might have, gone online and done some things themselves, but they haven't really thought things through in terms of what does the estate planning outcome look like? So have I thought about, okay, I've got the insurance in place, I've done it myself, but what guarantee have you got that it's going to go to who you want it to go to, and that it's well protected against, future family breakdowns if they happen to, enter a new relationship and it doesn't quite work out, or if they're in business and they go bankrupt, or there's so many other things that can happen that could affect the capital that you've left behind to those that you love. So most advisors these days will be going through a whole list of things and thinking about all of these issues in the background of these conversations to try and then make sure that what they advise their clients on takes into account all of those considerations.
Yeah, I love that it's not, even if you've got enough insurance, making sure it goes to the right people is so important.
Yeah.
Okay. One of the things we always like to ask our guests as a final bite is, say, the best piece of advice they've ever heard.
Wow, that's a big question. But something does come to mind pretty readily. And that was that an experienced, quite wise older friend of mine made a comment to me once. I'd been asked to do something which carried a little bit of responsibility with it. And he said, if I can give you one piece of advice, he said, there'll be times in your life that you're faced with challenges, in particular in the way that you deal with people. And you may not know quite what the right answer is or what the best thing is to do. He said, but if you treat people with kindness and care and allow that to be the dominant attitude that you display, even when you're in a bit of a crisis situation, then you can never go wrong. And I've tried to live by that. And so far it's held me in good stead.
I think that's a great place to finish. That's a great piece of advice, Tim. Really
Thanks, Marc.
appreciate your insights into life insurance, because it isn't a simple subject, and getting advice. And it's just, as you said, not even just getting the amount of insurance and the type of insurance, but make sure it goes to the right person, I think is a great point. And just really appreciate your thoughts there, Tim.
No worries, Marc. And I wish you all the best, and all the best to your listeners as well.
Thank you. I hope you enjoyed this episode. If you'd like to know more about Tim, visit hendersonross.com.au, or feel free to email me on admin@themoneysandwich.com, or visit our website, themoneysandwich.com, if you have any questions or would like to know more. Visit my website, themoneysandwich.com, for free templates, online calculators, and subscribe to our newsletter to help you now for a better retirement tomorrow. As with every podcast, this information is not advice, as not personalised to your own situation. And past performance is never guaranteed for the future. What we are trying to do here is to provide tips, coaching, and education to help improve your money knowledge, which we believe can only be a good thing. See you next time when we take another bite from the Money Sandwich.